Hi, everyone. We're going to go ahead and get started. We would like to welcome you to today's Lunch and Learn Financial Stability, a primer for practice managers, part 1. Part 2 will be next Wednesday. This webinar is part of the North Carolina AHEC Practice Support Services Lunch and Learn webinar series. A quick reminder for everyone to please mute themselves. There will be designated times during and after today's webinar for questions and comments. Also, if you wouldn't mind just putting in your name and your practice in the chat box, just so we can see who's joining us today. For now, we will hand it off to Mark and Ramin.
Well, good afternoon, everyone. Appreciate you being here and appreciate the opportunity to present some ideas for you as you plan for the future and think about how to be successful going forward. As you can see, I'm Mark Holmstrom. My teammate Ramin Sadagian is here, and we're kind of tag teaming this. We've got a total of 6 sections. I'm going to do 3. Ramin's doing 3. So we'll kind of pop in and out depending on which section we're on. So again, appreciate you being here. And what we're going to really focus on is the idea of sustainability. And hopefully give you some concepts and tools to really think about how you plan for future success. And when we talk about sustainability, we're really getting to the idea of long-term intention to continue providing services, to grow and remain in business. It's certainly possible to focus on day-to-day or month-to-month activity, but we feel it's really more sustainable to look farther in the future and try to be as predictable as possible and implement certain planning activities. So over these next 2 sessions, we're going to kind of start at a high level in terms of what you can do to envision the future. With the idea and concept of strategic planning and budgeting and using financial reports and KPIs to really kind of plan the future. And then next week, drill a little bit more into the detail in terms of effective payer management. How do you look at value-based contracts? How you manage your current payers? Looking specifically then at revenue cycle and KPIs around revenue cycle, and then some specific tools on how to analyze new services and new things going forward. So that's our roadmap for the next 2 sessions. And we really hope this is very beneficial and at least something that you can take away and use in your practice. So I'm going to start with, again, kind of a global picture of strategic planning. And planning really is an intentional process that an organization takes to set or revise kind of the basis for the practice, why you're there, what your purpose is, what your values are. And it kind of starts with mapping out, a mission, and that's your reason for existence. Why are you doing what you do? Why are you there? That tag teams with the vision and what you want to continue to do, where you see yourself as an organization in the future. And that's what the vision is, just kind of thinking about where are you going, where do you want to be in the future. Values are important to really define in terms of your organization and the key ways you make decisions. What are your core principles that will guide and direct your organization, the culture, as you move forward and decide what your future looks like? And then the planning, process ends with envisioning the future and applying mission, vision, and values to your planned actions and what you're actually going to do in the future. So strategic planning can be complex, can be detailed, or can be simple. Some of you in large organizations may have gone through a specific strategic planning process, which generally entails you having a multidisciplinary team around the table, provider champion, administration, business office folks, marketing folks, clinical folks, having a team together to work together to really envision the future and come up with a plan. And that team generally, starts with, analyzing your environment. What's going on around you that will impact your decisions and will drive what you need to do to be successful. Many times you may have heard of a SWOT analysis. Well, that really is just looking internally at your strengths and weaknesses. What do you do well? What do you not do well? And mapping that towards opportunities that are in your environment, as well as acknowledging certain threats or things that are going on that may be detrimental to your practice. Once that is done, then the organization usually starts setting goals and objectives. What specific things do you want to achieve in the future, and how are you going to achieve that? And then the final step is to really put in an action plan to meet those goals and objectives. So that's a description of kind of a more complex planning process. Again, large organizations sometimes go through this process because there are a lot more factors to consider and build in. But strategic planning can be simple as well, and asking yourself and your organization a few key questions, such as, what specific patients do you want to serve? What specific patients will be served? And what will you put in place to make a compelling value proposition for those patients to continue to come see you? So that's more of a simple way to think about the future and planning. And it's really what planning is about. Who are you going to serve? What are you going to do to make sure you're serving their needs so they remain your patients, and then you can grow? So, you can be complex or simple in terms of your thought process related to strategic planning. Generally, after a planning process, you develop, some type of document that you can maintain and track your progress, as well as communicate to your organization what that particular plan is and what you're trying to achieve. Usually has specific goals and objectives. Planning generally is longer term, 3 to 5 years in terms of strategy, because a lot of things take time to implement, and change takes some time once you make some changes or to determine what your future is going to be like. A plan should incorporate a number of sections and ideas. What patient services are you going to provide? What population are you going to serve? What ideas of growth do you have? And then building in your quality goals and financial goals. All should be part of that strategic plan and thought process for the future, because those will help you determine what you need to do, what actions you need to take to achieve your long-term goals. Some documents are long. You've probably seen these binders of strategic plans that someone puts on the shelf. A more useful way to portray it may be a one-page synopsis, where you can use this to communicate to your organization what your mission is, what your values are, what you're trying to achieve in those different areas, and including KPIs or key performance indicators. What is it that will show that you're successful? So this is just an example of kind of a one-page synopsis of a plan that again you can pull out very easily and share very easily. Going back, I want to go back to the idea of, I'm going to go back to this slide, creating a compelling value proposition. An example of that is leveraging technology. If you have a particular patient population that that really uses technology a lot. You know, you want to be able to serve them in the way they want to be served. So how well are you implementing your portal? How well are you implementing text reminders and the whole idea of technology? And that's just one idea of reviewing, you know, value proposition for that particular group of patients. So that's just one idea as you think through, you know, your patient population. What is it that creates that value for them? As just kind of an example. So I'm going to go forward here. So here's just a couple questions that you can ask yourself or take back to your organization and think about your process for planning for the future. You know, do you have a strategic plan? How many years does it cover? Is it time to update a plan? You know, how often do you review and revise that strategic plan? All these things will help you kind of think through your process for visioning the future. Who is involved in long-term planning? And then, you know, just reviewing your different sections and things that you consider with planning. Are you considering, you know, the population? Are you considering quality, you know, fiscal measurements and growth? So just some self-reflection questions to think about going forward with the topic of strategic planning. So that's a kind of quick summary of thoughts regarding strategic planning. We are happy to answer any questions. Feel free to put them in the chat. I think Danielle is reviewing the chat. Any questions out there, Danielle?
No, we currently don't have any questions. Also, feel free to unmute if you have a question that you'd like to ask.
All right, we'll keep moving forward. If you think of a question, again, feel free to put it in the chat or come back to it as we go forward. So the next layer down, once you have your direction, we feel it's really good to have a budget and put on paper your financial plan for a specific period of time. You know, budgets usually are typically 1 year and project, you know, revenue and expenses. You know, budgets are used to create and name your financial goals for that particular year. They should also be used to set financial expectations and what you expect to happen. We also always suggest that any tool should be a useful tool. And a budget really can be a decision support tool and help you monitor change and help you look at variances and kind of see what's changing, what's going on within your with your business. So we're going to talk a little bit more about variance analysis in a minute. But that's really the purpose of a budget, to really put that plan on paper and have something that you can monitor your progress throughout the year. There are multiple types of budgets. The most common are a zero-based budget or an incremental budget. A zero-based budget really is more useful if you're adding a new site or a new program or some type of major organizational change. Because zero-based budget basically starts with a clean slate, and you're building your budget based on something new. You know, what new revenues you're going to have, what new expenses you're going to have. So it's really best used for a new program or new clinic or something like that. Most of you who have done budgets probably use the incremental process, where you move forward from previous year's numbers. You kind of use, you know, last year's numbers as the baseline and adjust your budget based on what you know is going to happen in the next year. You know, are you adding a provider? Okay, if you are, you know you're going to have additional revenue, but you're also probably going to have additional staff. So you build that in. So it's really, adding on to your previous financial experience based on what you know is going to happen in the future. And that's generally what most organizations do in terms of budgeting. So those are just a couple more common types of budgets. When you look at how to format the budget, again, it can be simple or complex depending on your practice. It generally has 4 key sections. Your volume indicators, what is your projected volume? Revenue based on that volume, what do you expect the income and the revenue to be? Then you have the expense section to detail how you're going to spend that money. And then the hopefully net income section in terms of what you're going to end up with at the end of the year, hopefully as a positive number in terms of net income rather than net loss. Usually most organizations use a format that mirrors their income statement or their profit and loss statement format. It makes sense because that's how you're going to track specific line items. And again, most accounting software either generates the budget or certainly drives the chart of accounts and the accounts that you're using. So accounting software can be very helpful in terms of budgeting and tying it into the income statement as well. So here's a picture of just an example, a very simple example, which has those 4 sections that I mentioned. Key volume at the top, revenue, expense section, and net income. One of the things that I'd like to include, in a budget is some indication of how you're spending your money. So there's that section that says percent of receipts. And that's something you can kind of use over time to monitor change. Healthcare is generally very heavy on salaries and labor expense. And so it's a way to kind of gauge where you are in terms of your percentage of your revenue spent on different line items and different expense categories. So I've always liked to kind of have that indicator so I know kind of what my big expense buckets are related to my receipts and revenue that's coming in. So that's just a simple example of a budget. As I mentioned before, a lot of times, people don't particularly enjoy putting a budget together, and sometimes feel like it's just an activity that has to be done once a year. Well, there are certainly ways to make it useful, and it's really kind of what we want to focus on today is how can you make the budget a useful tool. And it really comes down to using it for variance analysis and looking at what is different between what you have planned and what is actually happening in your organization with your volume and income, revenue, and expenses. And you can use it to identify problems and use it to identify areas that may need some improvement. So as you go forward throughout the year, you add, a variance column to your budget and the variance percentage column. So you can see kind of where you are month to month, as well as kind of a year to date aspect of where you are in terms of the planned budget and what's actually happening. And sometimes, when you look at it, sometimes the initial reaction is to see a negative variance and automatically assume that's bad. That's not necessarily the case. For example, your billing service fee may be higher than expected. Well, then you have to look up and look at, well, okay, so my revenue is also higher than expected. So that is, expected and a good thing, right? If your revenue is higher, then if you have a billing service fee, that might be higher too. So you can't always just say, negative variance is bad. Variance analysis Also allows for comparison to see if changes or differences are reasonable. If you look at the orange circle under medical supplies, the year-to-date variance is 36% over budget. So can you look horizontally on that line item and say, okay, we know we're over budget, spending more than we expected. Is that reasonable? So then you can look vertically and kind of say, okay, what drives medical supplies? Well, generally volume will, right? So you can say, okay, well, medical supplies are over 36% over budget. Our receipts are only 15% better, and our volume is lower. Okay, so that's kind of an indicator. Okay, there may be something going on with our medical supplies because that budget variance doesn't match, the revenue or volume experience. So it's an indicator to potentially drill down into that line item to see what's going on with medical supplies. So that's just a way to use this variance to identify an area that might need to be improved or looked into to see what's going on. Another potential use of variance analysis is that green circle under repairs and maintenance. There may be, you're over budget by 29% in this particular example. So that may be an indicator that there's some equipment that is failing more often than you knew, and you're having to spend more money on repairs and maintenance. And so that may be an indicator there may be a piece of equipment that might be time to replace. And then you just have to go through the analysis of does it make sense to replace? That's a whole nother kind of discussion. But the idea here is that the budget can identify an area that may need to be improved or something may need to be adjusted based on a budget variance. So that's some basic examples of how you can use the budget to really identify opportunities for improvement and to make the budget useful. So our self-reflection questions for you related to budgeting is related to kind of what you're doing with it. Do you have a budget and a specific plan? How often do you prepare it? How often do you review it? Do you actually use it for variance analysis? And then that last question kind of is an action question. Have you actually used it to make some decision or change based on the variance analysis? So just some, again, things to think about and consider as you review your process for budgeting. So I'll stop there again and see if there's any particular questions related to budgeting or back to strategic planning.
We do have a few questions in the chat. The first one is, can you give some examples of quality goals and financial goals?
Sure. I'm going to flip back here. I'll start with the financial goals. Let me go here. Financial goals can be related, I think, to any one of these sections, right? You can, from a financial goal, you can say, okay, we want to grow our numbers of encounters by 10% this year. Or our revenue, we want to grow our revenue by 25%. You can set goals for expenses too. We want our expenses to only be, X% of our revenue. So really, financial goals to me are driven either through the budget or the income statement. And those are just kind of some examples of financial goals. Clinical goals really speak to, I think, performance metrics in terms of your quality metrics. Again, a lot of times, to me, it makes sense to do kind of a percentage change type goal. For example, you want to increase your immunization, your flu vaccines given by 10% this year, or whatever your number is. It's always good to make sure they're reasonable goals and achievable, but stretch enough to challenge you to really look at your workflows on how to improve to meet those particular goals. And again, clinical metrics is going to be different based on your type of practice and your specialty. So really make it meaningful, to your practice and improving the patient outcomes for your particular patient population.
Another question is, what are your suggestions for how to budget unknown revenue? For example, monies from ACO performance that is unknown until after year end.
That is a good question. Ramin, did you have an idea there?
It is a great question. Those value-based goals are harder to project and also important. You could do it in a couple of ways. I personally would, try and build a model without the value-based payments to be solvent, and maybe roll that into your strategic plan. Well, hey, we're going to use our Medicare shared savings to reinvest in this new service line that gets us to where we want to be in 3 years, for example. And if I were to incorporate the value-based payment into my budget, I would just manage my risk. I don't want my budget to be based, 50% on Medicare shared savings. I might have my budget set up where I can maintain operations and only need 10% of those costs to come from the shared savings. So I'm kind of managing my risk where I'm not leaning on that value-based payment a whole lot and using that as a strategic opportunity to reinvest in the practice to kind of get us where we want to be from the strategic plan 3 years from now.
And this is a similar question. What's the best way to account for seasonal volume differences?
Well, I think to me that kind of goes off of historical knowledge, what has happened in the past. And then generally a budget can be, you can do it for a full year, or you build it month to month. And if you really have a lot of seasonality in terms of revenue change, it may make sense to do more of a month to month. So okay, your summertime, quarter 3 has a historically higher revenue. And so that's definitely another way to do it, and a way to build in seasonality is look at what from the past and build that in month to month, based on when that's when you assume that's going to happen based on your history.
That's all the questions we have so far. Any other questions?
All right, so we'll move forward on. Turn it over to Rami.
All right. Well, hello, everyone. I want to talk about some financial statements. And before we get into this income statement specifically, just financial statements in general, right? We're using them so we can measure our financial performance. These statements help provide insight into operations and help us ask questions and look into things. And these financial statements are a source of information, right? They're directly in line with the budgeting process. We use a lot of financial numbers as part of our key performance indicators. And that's kind of why we're using these financial statements. Going to get into this first one here, the income statement. It's the most common one I find in businesses. Some people refer to the income statement as the profit and loss statement. Other people call it the P&L statement. And the income statement has, what you're basically looking for out of the income statement is, we bringing in enough revenue to cover provider and staff labor, as well as our remaining expenses. In other words, we're just keeping an eye on operations to making sure we're solvent, right? We're generating income, not bleeding cash, for example. And this is a pretty important statement. I'd review this fairly regularly. I'd recommend monthly, at least quarterly, to review the income statement. And what you see here in front of you is an example of an income statement. And I'm going to take a little time talking about this page. First of all these line items that you see here, for revenue and expense account and the amounts associated with them together, they're referred to as your chart of accounts. And this shows a lot of accounts. And typically your smaller organizations are going to have a slimmer chart of accounts, right? They're going to have bigger buckets or bigger aggregates for their accounts. In your larger organizations, they're going to want to dial into smaller aggregates. They're going to have a lot more chart of accounts because they're going to want to be looking into more specifically where their costs are going because they're a lot bigger and have the capacity. And so all income statements come down to kind of three basic sections. And you got the revenues, and you can break that out however you want. For example, this shows immunizations and vaccines. They've pulled that out from their regular revenue from E&Ms and other claims, because maybe in the strategic plan we either enrolled vaccines as a new service or something we wanted to focus on and expanding. So this is just an example of how that plan trickles down into the income statement. Right, we've pulled out vaccines and immunizations so we can track that separately from our other income. And then we have kind of two sections for expenses. There's always one for payroll, and then always one for everything else. Your payroll is generally broken down into owners or physician payroll, and then you have a separate payroll for staff. And then you get into your expenses. Right. And again, this is kind of depends on your size of an organization. This example is pretty simple. It's included all the expenses in kind of a general and administrative category. Your larger organizations might break this down into finer pieces, right? You could have subcategories. Common that I see is, at least for operating expenses and overhead expenses, where you could put your medical supplies and office supplies and inventory in your operating expenses. And then you could have another category, for example, for overhead. That's going to be your rent and utilities and bank fees. And that way you just know what you got to spend to keep the roof over your head, and what you got to spend on supplies and things to keep operations going. And those are just some examples. And, when you're looking at the income statement, kind of goes back to what Mark was saying. This is going to be a theme of our presentation this week and next week, is you're looking for variance, right? This income statement is a current month. And with most accounting software, QuickBooks is a common one. It's really easy to generate this report, and you can see this income statement versus every month this year. And that can kind of give you an opportunity to look for variance across the months. Or if you want, you can review this income statement versus the same month last year. So if this is January's income statement, we could compare January this year to January last year, and that'll help account for some of the seasonalities potentially in one of the questions. And you can build this income statement however you want, break down the categories, and you might add categories if you're trying to monitor new service lines that came from your strategic plan. Like this example might be vaccines and immunizations. That's just an example. And this income statement is a key source of information, right? Your budgets come from this income statement. You're basically mimicking this income statement. You can get dialed into budgeting as you want, but like the simplest approach would be, if you want to budget repairs and maintenance, see what you've averaged monthly per month on repair and maintenance, and that's your baseline for your budget. And that way you can just compare to that average. And that's just a really simple example of how you can use this information. Another source we often use this for is key performance indicators, your KPIs. Something I love doing as a practice manager is seeing how many appointments we had in the month and dividing it by one of those categories on the income statement. And that way I can see how much I'm spending on medical supplies per appointment, or how much we're spending on overhead per appointment. And here's an example you see of some simple KPIs. I managed a specialty practice for a number of years, and this is one of our leading KPIs from a financial standpoint, is we took all our revenues, and that came from over-the-counter products, from claims space, from non-medically necessary procedures. We took all our revenues and divided it by the number of appointments we had in a month. And we came up with about $218 per appointment we're bringing in total revenue. And then you can use that income statement to see how much you're spending on staff labor or operating cost or overhead cost. In this example, you see where we were spending about a quarter on staff labor, about 20% on operating cost, and nearly 30% on overhead. And that left our margin, our operating margin per visit, right? So our physicians, were kind of making $64 per visit, or you could say for every visit we had, they were keeping about 30% of the income. And from there, $64 a visit, you can do some simple math, 18 appointments a day, 4 days a week. You can project an income for a physician of 200 grand a year. And this is just an example of how you can use these performance metrics to go back to your strategic plan. Maybe you want to add a physician, or you want to improve owner income. You would use this as a key performance indicator to monitor your success along that strategic plan. And I think we can go to the next slide here, Mark. And another common financial statement that I want to review with y'all is the balance sheet. And balance sheet kind of has two main components that I like to look for, or two key pieces of information. One is the immediate perspective to pay your bills. And another one is kind of a long-term perspective, and this is more owner equity and how much value the practice has. And this is a less common statement. I'd review it on occasion, maybe quarterly, certainly annually. I'd recommend reviewing a balance sheet. I might review it more if there's like rapid change. For example, when COVID first came, a lot of turbulence, I'm going to review this balance sheet more. Or maybe if we added another practice or another service line, those type of changes, I'm going to review the statement more. Where if things are more kind of the same, I might review it less regularly, 6 months or annually. And yep, we can go to the next slide. So here's the kind of the two pieces of information that I recommend from the balance sheet. And the first is kind of that short-term perspective, right? Your ability to pay your bills. These are your current assets, your current liabilities. And in this example, right, they're saying we got about $87,000 in money that's owed to us in accounts on hand. And we have about $12,000 or $13,000 in bills that we have. And so you do some math, $87,000 divided by 13,000 that we owe in bills. We basically have about $7 in cash for every $1 in short-term debt. And the healthcare benchmark is a 4-to-1 ratio. In this example, we have a 7-to-1 ratio of cash versus short-term debt. And that just makes me pretty confident as a practice manager, that we're able to pay our bills. And then you can give me a click here, Mark, and we're going to go to the longer term perspective. And this is more for owner equity. Another word for equity is value, how much you're worth. And here we can take our equity and see how much we owe it. For example, if we closed our practice today and we paid off our debts, right? Maybe we financed some equipment or those type of things. We want to see how much money we have left after paying off our debt. And in this example, we got about, we'll call it $80,000 in equity, $40,000 in debt. So we have $2 in equity for every $1 in debt. And, that's a good place to be. Just suggest that if we close and pay our assets, we have some income to distribute. And, and this ties back into your budgeting and strategic plan. You want to use this balance sheet to help monitor the initiatives that you put together in that strategic plan, just to making sure they're not throwing off your ability to pay off your short-term debts, and to make sure they're having a positive impact on the owner equity. That's how I'd use the balance sheet here. And again, you're looking for variance over time, right? You're looking at this quarterly or a couple times a year or annually. And you want, if you see a major change, whether it's in this balance sheet or anything you and I, Mark and I talk about, you just want to be able to explain that change. It's triggering you to go find out why, and there might be an opportunity there. And just some self-reflection, for you folks to kind of think where you're at along the financial statement is, first question is, do we review income statements? Do we look for variance? How often are these financial statements reviewed? What are the key performance indicators that we're using? How are they tracked? How are they monitored? And who specifically reviews the financial statements? Whether it's just the owners, or if it trickles down to department heads. And if I have someone managing inventory, I'm going to share them that component of the profit and loss statement or the budget to see where that regarding inventory. And you just want to map out who has access to those metrics, just so you're keeping tabs on people's performance and you're letting them know where they're at. And again, you're using variance a lot to pursue these opportunities. And those are my notes on financial statements.
We have a question in the chat from Michelle. Where do you find the best practice KPIs?
The best practice KPIs, we're going to talk about them a little more next week, but I showed you an example of a key performance indicator. I like seeing how much we're making per encounter and how much we're spending per encounter. And then the American Academy of Family Practice has some good resources there. They're included in these slides for you to click on, and it'll show like really plain examples of how you can go about calculating these KPIs, and even has videos. And of course, you got AHEC practice support. If you need some help picking some KPIs or how to calculate them, reach out to practice support. And they might include Mark and I in that conversation if needed, and we're certainly a resource for you.
So I think at the end of part 2, I think we left that slide off this first section. So there'll be a resource slide on the part 2 group that has some links, specifically to the one that Rami mentioned, the AAFP has a really good document out there that lists some common KPIs. So we'll get that to you in that section.
We don't have any other questions in the chat.
All right. So next time, we're going to get even a little more detailed in terms of some more specific information on how to manage your payers, how to think about value-based contracts, how to look at your revenue cycle and some KPIs specific to revenue cycle. And then Ramin has some really good practical examples of how to do some fiscal analysis for potential new services. So next week's going to be, drill down a little bit more to some more specific tools. Today we wanted to kind of lay a more broader perspective in terms of planning and budgeting and some initial things to think about as you consider sustainability and planning for the future. So if there's no other questions, Danielle, do you have any other announcements or anything you need to mention to the group?
Just a reminder that the slides and the recordings will be available. You'll just have to log into your AHEC account and then select My Course and Events, and then you'll locate the Lunch and Learn, and you should see the slides and the recording. The slides should already be there. The recording will be there this afternoon. And I just wanted to thank you, Mark and Ramin, for this wonderful presentation, and thanks to everyone for joining us. And we hope to see you next week for part 2.
Thanks for having us. Thanks for joining us, everyone.
Thank you.